All right, this is problem 7.15 from Brigham and Houston's Fundamentals of Financial Management, Concise Ninth Edition. This problem's a little bit convoluted, which means that you should always read through the problems to make sure what you're trying to solve. Bond X is non-callable, and that means that it's going to go to maturity. So it's got 20 years to go, an 8% coupon, $1,000 par value. Your required rate of return is 9%. That means that whatever you pay for something, you expect to earn 9% on your investment. If you buy it, you're going to hold it for 5 years. You and the market, so that means that your expectations of interest rates are consistent with everybody else's. You expect in 5 years the yield to maturity on a 15-year bond. Now remember, it's 20 years to go now. 5 years from now, this bond would have 15 years to go. And you would expect that the bond's yield to maturity 5 years from now would be 7.5%. So how much would you be willing to pay for Bond X today? Okay. Hint, you need to know how much it'll be worth at the end of 5 years. All right, so let's first figure out what we think the bond's going to be worth 5 years from now. If it's paying $80 a year, 8% coupon, remember almost all bonds pay semi-annual coupons except the ones in the textbook, okay? But this is just to simplify the math a little bit. 5 years from now, the bond will have 15 years to go, and you and the rest of the market think it'll be yielding 7.5%. So let's see what you think the price of the bond will be in the future. All right, rate, number of periods, payment, future value. So your assumption is that that bond will be worth $1,044 in 5 years. So how much should you be willing to pay for one today in order that you earn 9%? Well, that's a separate calculation. You're going to hold the bond for 5 years. If you bought this bond, you get $80 a year for 5 years. And then you expect to be able to sell it for $1,044 and change. Let me keep the numbers consistent. If you require a 9% rate of return, how much should you be willing to pay for it today? $989.79. So let's set up a timeline on that. If in year 0 you took $989.79 out of your pocket, in year 1, 2, 3, 4, and 5, you put $80 in your pocket each year, and then at the end of the 5th year, in addition to the $80, you then also sold it for $1,044.14. Then your rate of return, which we could solve using IRR, would come out to exactly 9%. Okay? So investors, when they're out there doing bond pricing, they have a holding period that they expect to hold bonds for. The price of bonds, like the price of common stock, goes up and down all the time. Okay, so prices move up and down. If you make these assumptions, if you were willing to pay $989.79, you're pretty sure you're going to get the $80 a year unless the bond defaults. What you don't know is whether you're actually going to get this $1,044 price, but if that's your assumption, that's how you build in the price you're willing to pay on any particular investment. Nobody knows what's actually going to happen, but they have educated guesses, and you base your price you're willing to pay on those educated guesses.